Welcome back. Sometimes when you're going into business, you start up right from scratch. Other times you acquire an existing business. We're going to talk through some of the legal elements around acquiring a business that's already in business. The first question you need to ask yourself is, what are you actually buying? There's two basic methodologies to buy a business. First one's an entity sale. So you're buying the legal entity. So if you're looking to acquire Jane's Florist, and Jane's Florist is Jane's Florist LLC. If it's an entity sale, you're buying the LLC. So you're buying the membership interest in the LLC, and you're assuming all the liabilities and assets that are within that LLC. So you're buying the legal entity, and you're buying all the assets and any liabilities that remain in that LLC. The other choice is you can do an asset sale. So instead of buying Jane's Florist LLC, you buy the coolers, the flowers, the inventory, the equipment, the leasehold improvements, the goodwill, and leave, you may assume certain liabilities. So you may assume the trade payables, you may assume the accounts receivable, you may assume a note, you may assume a lease, but any that you don't explicitly assume remain with the old entity, Jane's Florist LLC, and instead you might have John's Florist LLC as your new entity. That entity acquires the assets and the liabilities. There are liability advantages to doing an asset sale, because if there's an unknown liability, so for instance, somebody ate one of the flowers and got poisoned, and that lawsuit hasn't arisen yet, neither you nor Jane know that the lawsuit is out there. If they sue, and that occurred prior to the sale, if you acquired the entity, that lawsuit will probably follow the entity over to you, and you being Jane's Florist LLC will be liable for the damages associated with that, even though it wasn't while you owned it, because the entity is a legal person, is considered a legal person, and so as a result, it has to bear the liability. Where in an asset sale, if you didn't explicitly acquire that liability, it doesn't come over, and it sits with Jane's Florist LLC, and so you've got some liability protection. You also have some tax advantages, because when you step into an LLC, depending on what the LLC operating agreement looks like, and certainly with corporations, and you end up in a situation where you assume the basis, or you may be assuming the basis of some of the assets that are within that entity, and you may not be able to amortize the goodwill if you pay over the actual market value of the assets. When you do an asset sale, you're going to be able to take a look at each of the components that you buy, and there's 10 different buckets that the IRS categorizes assets in, and you can assign a fair market value to each one of those, and they all depreciate or amortize at different rates, but you've got some tax advantages there as well. Again, this isn't a taxation course, but I just want to point out to you that as you're going through this acquisition of a business, you've got tax considerations, liability considerations, as well as just ease of doing business considerations, whether you choose an entity sale or an asset sale. When you're going to acquire a business, you conduct due diligence. Due diligence is the fancy term or term of art for checking everything out and making sure the business is what you think it is. And it's probably the most important pre-purchase activity you're going to conduct. I'm going to walk through some of the key things to look at in due diligence. It's by no means an exhaustive list, but these are things that you should be thinking about if you're acquiring a business to make sure it actually is what it is. And it is as it's being represented by the sellers. And so you're going to want to have multiple years of company books and records. And when you're looking at those company books and records, which is going to be your financial statements and any corporate records, any legal records, etc., you're going to want to take a look at those and see how the business has been performing over time, whether it's on an uptrend or a downtrend, whether there's been any unusual expenses that occur that kind of spike things around. You're going to want to look for anything that might raise a question to you as to what happened and what the general trends are. And don't overlook things or just dismiss out of hand, well, that must be X. You should ask the question and move forward. You're going to want to look at their tax returns. You're going to want to see how much they're actually reporting to the IRS. Nobody deliberately, or most people won't deliberately overstate their taxable income. And so the tax returns I found in my capacity in doing due diligence for the last 20 years or so tend to be a very valuable tool to look at in conjunction with the company books and go, okay, how much are you really making? What are the differences between what you're reporting out in your books and what you're reporting to the taxing authorities? Because one may have some unknown liability there, but also you're going to be able to determine how much cash is really coming through the business and how much you're really making. Accountant opinions and management letters. If the company you're looking to acquire has had a review, a compilation, or an audit, those are going to come with opinion letters from the accountants in addition to the prepared financial statements. They're also potentially going to come with a management letter. And what a management letter is the accountants take a look at the books and records, they take a look at the controls environment, they take a look at how the business operates, and if they have recommendations around things that should be changing, where there's potential weaknesses in the controls or where there's potential misstatements in the financial statements that don't rise to the level of them essentially calling foul and saying that they need to be fixed or restated, but where they do come to the level of needing to make management aware, those are going to be in the management letters, and you're going to want to make sure you look at those to see if there's anything that looks unusual. You're going to want to look at licensing and regulatory information, which is going to be public information generally available with your state and local and potentially federal, or if you've got an association, a trade association with a trade association, to see how the entity has been performing, whether there's been any complaints, whether they're up to date on their licenses, whether they've been filing things on time. UCC search and legal search. We're going to talk a little bit about UCC later in the course, but that's Uniform Commercial Code that governs most contracts. And if you enter into a bank loan and they secure it with your inventory, for instance, they're going to file a UCC, generally with the Secretary of State's office in the state in which you reside or in which your business is. And that UCC puts people on notice that the inventory is collateral for the loan, because you can't just attach the inventory. And when you trade things, that's, if you buy a new car and you get a title, the bank will put down that you owe money on the title. If you have a house, they'll file a mortgage. And in the case of a commercial loan, they'll file a UCC. And again, all three of those things are to put people on notice that in order for that asset to be released, the loan underpinning that asset needs to be paid off. And so you're going to want to do a UCC search, because they may try and sell you something, piece of equipment, a stove, for instance, that they acquired, where they financed that stove. There may be a UCC filing on that stove, and you need to have that UCC released by the borrower or by the lender before you end up closing on the transaction, or at closing, some of the money needs to go to release that UCC. You're going to want to do a legal search as well to see if there's any lawsuits pending or lawsuits that have settled. That can tell you a little bit about how the company operates and whether there's any significant issues that you should be thinking about from a risk perspective or from an insurance perspective that you haven't contemplated when you were talking to the buyer or to the seller originally. Key contracts are important to review, whether those are on the vendor side or whether those are on the sales side, because if you have contracts that are single source, for instance, for acquiring particular goods or services which are necessary to do business, and those contracts have provisions which are going to be very difficult for you to either assign or transfer over to the new business, or which require you to enter into new contracts, you're going to want to look at those. We've seen situations in the past where folks have entered into a buy-sell, they've acquired the new business, the contract that they had to negotiate a new contract, that pricing was grandfathered pricing that was 7 years old, and now they had to enter in a new pricing, and the pricing has risen considerably over time. And because the original owners had a grandfathered contract, they were paying below market price for a critical good. Once the business transacted and they had to go enter into these new contracts, the margin on the business went down by a significant amount because they were unable to get that same pricing on a critical component. And so as a result, that should have been identified during due diligence and most of those contract issues negotiated, because again, if you can't get that contract when you're pricing the business, you're going to want to put that in and let the seller know that, hey, I can't pay that for your business because I can't make the same kind of money you can make because this supplier is not going to give the same terms. Key employee agreements. If you're going to be retaining employees, you're going to want to know what the agreements are. You're probably going to want to enter into new agreements as well, particularly if it's a asset acquisition. Additionally, if you're going to let anybody go, you're going to want to look and see what the provisions of those employee agreements are. What I found has been a general best practice is I have required, when we've done an acquisition, I've required that the company we're acquiring terminate all their employees, every one of them, at closing, and then we will rehire those employees under the terms, salaries, and conditions that we choose to immediately on closing. So essentially you have a mass termination, and then the next minute everybody enters into new employment that we want to keep. So that way, if there's severance provisions or other weird or strange things sitting on the books, all those have been dealt with by the prior owner, and then we start fresh with the new employees. That works most of the time. There's could be some other issues, but you're going to want to know what those key employee agreements are. Enter into new employee agreements for any key employees you wish to retain post-closing, and then for any that you don't, make sure that termination occurs prior to closing. And then the current governing agreement. So you may be talking to somebody who's like, yeah, I'm in charge here, I can sell everything, and then you get into it and you realize they don't have the ability to do it, or they have a silent partner who needs to acquiesce to the closing. And so you're going to want their current governing agreement and who owns what and who's required to consummate the transaction on the part of the business. The major steps in acquiring a business, you first are going to go through I'm going to find the business that I like. I'm going to talk to sellers. I'm going to potentially work with a business broker. And then I'm going to, once I find something I like, I'm going to enter into a non-binding letter of intent. And this essentially is, there's form letters out there that you can get. I generally recommend you use an attorney for it, but it's not necessary. It is non-binding. You want to make sure it says it's non-binding. And it essentially says, I would like to buy your business. Here's the price that I intend to pay. Here's how I intend to pay it. Here's when I intend to close. And it's subject to completion of satisfactory due diligence and any other conditions or contingencies that you want to put on that business, on that sale, you want to put in the letter of intent when you pass it over to the seller. Once you enter into the letter of intent, you give it to the seller. Seller's going to look at it. They may negotiate the LOI back and forth a little bit, and then you're both going to sign it. That's generally going to create a period under which you're then going to conduct the more detailed due diligence. So you conduct a preliminary diligence prior to doing a letter of intent, which is take a general look at the business, see how things are going, do a little bit of cyber sleuthing. Don't spend a lot of time, energy, or effort doing that detailed list that I just mentioned to you, because you may not even have the right price or terms. Once you get to that point, you then do confirmatory diligence, which is you conduct that deeper dive. You take a look at all that, those items that I had just mentioned on the due diligence piece. You're going to look at key systems, people, and customers. When you're acquiring a business, the reason you're acquiring a business as opposed to starting it up is that business already has systems in place, it has people in place, and it has customers in place. So you're buying essentially a forward-looking set of cash flows. And you're buying their systems, you're buying their people, and you're buying their customers. So it's not enough to just look at all the list of things that I had spelled out there, which tended to be more legal in nature. You also need to look at key systems, people, and customers. You're going to want to do an asset review as well. So is what they say they're selling what they're selling? Are the assets in good repair? Are you going to buy something and all of a sudden need to replace a key component on a machine? How is the maintenance performed? If you're looking at tangible property, if you're looking at intangible property or software or a SaaS type business, you're going to want to have somebody who's solid with technology, understand what the development cycle is, and how the technology was built, what the stack looks like, and whether it's being kept up to date. So you're going to want to conduct a significant asset review. As you're doing that, normally attorneys are working off to the other side, the seller's attorney and buyer's attorney putting the purchase and sale agreement, the PSA, together. this is one of those areas where you are going to want to have an attorney involved. You're going to need an attorney involved. And it is essentially in the case of the last business that I acquired, the PSA was approximately 2 inches thick. It's generally a very large document, very complex document. It's binding on everybody. So as you're doing confirmatory diligence, the PSA is getting put together. It's going to have the contract for this is what's actually being transferred. So all the assets and liabilities being purchased and retained, the contingencies that need to be followed post-closing. So if there was any contingencies pre-closing, those contingencies have been met, and that's agreed to in a purchase and sale agreement. So if there was a financing contingency, that financing contingency has been met. If the seller had to provide certain information or had to provide certain contracts for assignment, those contingencies have been met. And all the assets are as they say that they are. So those contingencies have been met. Indemnities. So if there's anything that goes wrong post-closing, and the buyer indemnifies the seller, which means essentially that if the seller gets sued for something the buyer did, the buyer will cover them, and vice versa. Warranties. This is normally going to the most important warranties are likely to come from the seller, and those are going to be essentially representations that the seller makes that certain things are the way that they are and that they haven't been misrepresented in any way. The consideration, which is, again, we'll talk about more about consideration when we come to contract law, but consideration is essentially how much you're going to pay, what's going to be paid for the business, and then any transition obligations that the seller may have. So there may be, the seller will work for 2 or 4 weeks or 6 months or a year to help transition clients or to help transition a new management team, that there may be post-closing restrictions as to whether the seller can hire former employees or they can compete, etc. And so those are all going to be in the PSA. You're also going to want to negotiate, as we had mentioned earlier in this lecture, the key employee agreements, so a non-compete and non-solicitation. Non-compete is essentially employees can't compete against your existing business. Those are enforceable in most states. Most notably, they are not enforceable in California unless it's the seller selling the business, in which case that non-compete is enforceable. Non-solicitation, which is essentially you can't solicit the employees or the business's employees or customers, or potentially interfere with their vendor relationships. And then post-transaction employment. So if you have key employees who are coming over, as I had mentioned, you're going to want to negotiate that post-transaction employment and then get those employee agreements inked while you're conducting the diligence. So at closing, everything is lined up and ready to go. So when you get to closing day, it's just like when you buy a house or any other major asset. Everybody sits down in a large conference room and you sign, and you sign, and you sign, and you sign. And there's generally going to be significant number of signatures on the various agreements that are going into place, or representations of warranties, and each one of those is backed by some level of evidence, and so that's how these binders get to be inches thick. And additionally, you're going to have certification that everything is the way that it is. So as you've been putting this stuff together, things could change, and so you're going to certify that there was no major changes or that the major changes have been disclosed. And then you're going to exchange consideration. So they'll hand you the keys, you'll hand them a check. Normally it's going to be, they're going to hand you the code to the door, and you have wired them the money, and then the business is closed, and you are now the owner of a new business. So again, you may decide, instead of starting up, you're going to acquire an existing business. Just remember as you're going through that it's a complex transaction. It's going to require employee agreements, and it's going to require legal involvement along the way. You're going to want to make sure we follow through all these steps. And that probably the most important thing that I see is you get a little bit of deal fever. You really want to get that deal closed. You overlook key warning signs along the way. That's where a good advisory team, so a good CPA, a good attorney, somebody who's been doing this before is going to be able to help you and kind of keep you in the box and make sure that you don't get too upset or don't with things that are small, or don't overlook things that are big, and help keep the transaction on task and on track in order to have a successful transaction for you and your team.